Canadian resorts overflow with tourists, while U.S. border towns stand quiet. The balance has tilted, and this is the shocking reason why Canada will replace the U.S. in global trade. The turning point began with tariffs. When Washington imposed duties on steel, aluminum, and other key imports, Ottawa retaliated with countermeasures. What started as economic maneuvering quickly bled into everyday choices for Canadians. Goods became more expensive, cross-border shopping less appealing, and the political rhetoric created an air of hostility. For decades, Canadians comfortably traveled south, spending billions in U.S. malls, resorts, and theme parks. Suddenly, the idea of supporting a country that penalized their industries felt less appealing. Families who once saw Florida vacations as routine began questioning whether their money should remain at home. Analysts noted a subtle shift. Frustration with trade policies translated into reconsidering travel decisions. The friction wasn't just about steel, it was about respect, reciprocity, and trust between neighbors. And as political tensions deepened, tourism emerged as one of the most immediate visible casualties. Canadians weren't just avoiding U.S. goods, many were preparing to avoid U.S. destinations altogether. Behind these personal choices lies a staggering economic truth. Every year, Canadians spend close to $20 billion traveling in the United States. That money flows into hotels, restaurants, retail stores, theme parks, and countless local businesses. Now, with trade disputes souring public sentiment, a significant portion of that spending is at risk of staying home. According to estimates, Canada could see an $8.8 billion boost to its own tourism sector if travelers redirect their dollars domestically. That means fuller ski resorts in Alberta, busier summer festivals in Montreal, and stronger bookings in Vancouver's hotels. What was once dependable revenue for border states like Michigan or Florida could instead fuel growth in Canadian attractions. This isn't just a reshuffling of vacation plans, it's a transfer of wealth on a national scale. Each decision by a Canadian family to choose Banff over Disney or Quebec over New York quietly shifts billions across borders. The numbers make it clear. The trade war's most surprising winner may be Canadian tourism. The real impact becomes clear when we follow where travelers actually go. Canadian tourists who once crossed the border for shopping trips, theme parks, or resort vacations are now more likely to keep their plans within Canada or look abroad to non-U.S. destinations. Instead of spending in Florida hotels or New York outlets, they are booking stays in Toronto, Montreal, and Vancouver. Ski trips that once went to Colorado are being redirected to Whistler or Banff. Even short family getaways are shifting, with Niagara Falls and Quebec City replacing traditional U.S. border runs. This isn't only about preference, it's about perception. Many Canadians see their spending power as a way to respond to U.S. trade policies. The outcome is simple. Dollars once fueling U.S. malls, restaurants, and attractions are now boosting Canadian equivalents. The flow of money has not disappeared, it has just changed direction. And with billions at stake, this redirected tourism pattern is reshaping both economies. For American border states, the consequences are immediate. Canadian visitors are a cornerstone of local economies in states like New York, Florida, and Michigan. When those visitors cut back, the losses are measurable. Hotels that once filled with cross-border families see empty rooms. Restaurants near shopping outlets notice fewer tables turning. Retail stores, particularly in outlet malls and border towns, report declining sales. In Florida, where Canadian tourists make up one of the largest international visitor groups, the slowdown directly threatens jobs tied to hospitality and seasonal services. The ripple effect spreads quickly. Fewer bookings mean reduced staffing, less overtime, and in some cases, layoffs. For local governments, lower tourism revenues translates into smaller tax collections, pressuring budgets already stretched thin. Economists warn that even a moderate shift in Canadian travel patterns can cost U.S. communities billions in lost revenue. What began as tariffs on steel and aluminum now weighs heavily on hotels, restaurants, and workers in America's most tourism-dependent regions. While U.S. destinations feel the loss, Canada's tourism sector sees growth. Ontario, British Columbia, and Quebec are positioned to benefit the most. Ontario gains from cross-border shoppers choosing Toronto malls or Niagara Falls over New York outlets. British Columbia draws travelers who might otherwise have gone to Pacific U.S. states, with Whistler and Vancouver hotels reporting stronger demand. Quebec sees boosts from cultural tourism, festivals, and historic city attractions. The ripple effect is broad. Airlines sell more domestic tickets as travelers fly within Canada rather than south. Restaurants in major cities see higher foot traffic. Hotels, both luxury and budget, experience stronger bookings year-round. Even local attractions, from ski resorts to national parks, feel this shift as more Canadians vacation at home. This redirected spending is more than a temporary bump. Analysts suggest it builds resilience in Canadians' tourism infrastructure, strengthens local employment, and reinforces the perception that supporting domestic industries is a direct response to U.S. trade actions. Canada's growing role in trade also creates a direct backdrop for tourism gains. While disputes with the U.S. have reshaped cross-border travel, Canada has actively built stronger trade ties with the European Union and Asia. Agreements like CETA with the EU and CPTPP with Pacific nations positions Canada as a stable, predictable partner. These trade links don't just influence container ships and exports, they shape traveler perception. Business trips turn into extended stays, conferences attract new international visitors, and stronger connections make Canada a more familiar destination. Tourism, in this sense, becomes a side effect of broader trade power. As Canada builds credibility in global markets, it simultaneously becomes more attractive to international tourists who see stability, opportunity, and cultural value. This dual benefit amplifies the country's gains. While U.S. tourism faces decline from its northern neighbor, Canada is leveraging global trade relationships to bring in both investment and people. The trade war may have started regionally, but its effects are now global. But does this trend mark a shift or a spike? If trade tensions persist, the tourism flow could become permanently realigned. Canadians who adjust their habits now may form long-term patterns, choosing domestic destinations year after year instead of returning to U.S. vacations. Businesses in Ontario, British Columbia, and Quebec would have time to expand capacity, further locking in these gains. On the U.S. side, prolonged losses in border states could force closures of hotels, retail outlets, and attractions that once relied on steady Canadian traffic. The economic weight of tourism would continue to migrate north, reinforcing Canada's advantage not only in trade, but also in travel. If relations improve, some spending may return south, but not all. Shifts in consumer confidence often outlast the disputes that trigger them. The central question remains: is Canada's tourism surge a temporary reaction, or the start of a permanent repositioning in the new global trade order?